Yes, sir. Yes.
Okay. So good evening, ladies and gentlemen. I welcome you all to this webinar. And this welcome is on behalf of Dr. Abhiman Das, a full professor of economics and the chair of the Mishra Center of Financial Markets and Economy at the Indian Institute of Management, Ahmedabad. I am your host for tonight, Prashant Das. I'm an associate professor of finance, specializing in real estate, and also a member of the Mishra Center. The Mishra Center was established with general support from industry leaders to foster research on financial markets and economy. Our affiliated faculty members specialize in a wide range of areas, including market macrostructure and microstructure, regulations, monetary policy, fiscal developments, commodities, banking, bond markets, SME financing, financial inclusion, insurance, and of course, real estate. Our activities would include training, and in addition to training, we focus on creation and dissemination of relevant research and engage with policymakers to influence policymaking, as well as we like to engage with industry leaders who help us develop research agenda, case studies, and other study materials. Today, our guest presenter comes from South Africa. Dr. Omokulad Akinsomi is a Nigerian working in South Africa and serving as the president of the African Real Estate Society. So he represents a heartily emerging continent that we all like to learn about. Dr. Akinsomi, a good friend who we call as Kola, is an associate professor at the University of Wits, South Africa, and serves as the chief economist of Real Quant Analytics. So it doesn't end in Africa. Kola holds a PhD in real estate finance and MSc in real estate from the National University of Singapore, that's Asia, and a BSc in real estate management with honors from Oxford Brookes University, that's Europe. He also serves on the board of the American Real Estate Society, that's America. So he is a truly global researcher. He is a qualified chartered surveyor and has held visiting positions at NUS Singapore, the University of Tokyo, and the University of Western Sydney. He is a member of the South African REITs Association Research Committee and serves on the advisory forum of the South African Council for Property Valuer and Profession. He serves on the editorial board of several journals, and he has earned several research awards, such as the National Research Foundation Award from South Africa and the 2019 Emerald Literati Award for Research Excellence. Today, he will present his research paper titled Mortgage Origination and Residential Market Segmentation in Emerging Economies, the Case of Ghana. We expect his presentation to last about an hour. You're welcome to ask questions or provide suggestions by typing in the Q&A window of Zoom. I will try to pose your comments to him as time permits. And we shall also have a Q&A session in the end if needed. Kola, the floor is yours now.
All right, thank you so much, Prashant. Let me just update my slide. Okay, can I just confirm that we can all see my slides?
We can, if you could start the slideshow.
Slideshow. How does it look?
Ah, perfect.
Okay, excellent. Thank you, Prashant, for that introduction, extensive introduction. I'm honored. And again, thanks for the invitation. As Prashant said, right, me and him, we go a little bit back. For myself, when I do sort of presentations, I try to always get the human touch to my presentations. And so just to give you a background of when I met Prashant, and I hope that he allows me to tell the story. I first met him at the European Real Estate Society in Regensburg, Germany. And that was the first time I met him, had a conversation with him. You know, he struck me as a very smart person. And then also I'd met him at the American Real Estate Society conference. You know, we've had a chat together. And also I was privileged for him to also invite me when he was in Switzerland, when he was in École de Lausanne. I hope I'm pronouncing properly. When he used to organize the annual conference, I was privileged for him to invite me to Switzerland as well. So yes, me and him go way back. And Prashant, thank you again for the warm invitation to present today. Okay, so, you know, I do have quite a number of working papers and quite a number of papers under review at the moment at several journals. But then I was thinking, oh, should I just present my best paper so that I can look good in this presentation? But then a voice said to me, oh, but you're the president of African Real Estate Society. So if you then come ahead and present something on Europe or in the US, you know, how does it, you know, it doesn't bode well for you as the president. Okay, and so it is my honor to share with you a working paper that I'm currently I can't really call it a working paper. I'd say it's almost done. We'll send it out to review, and I think we're under a second review at a housing journal. But you know, with all papers, there's always room for improvement, and you know, it never ends. Also, it's nice to see familiar faces, especially also Ghanaians also. And so I must be careful what I say in this presentation. Otherwise, you know, I stand to be corrected. There perhaps better experts on the Ghanaian real estate market than myself. And so today I'll be presenting my work on the mortgage origination and residential market segmentation in emerging economies, the case of Ghana. This work is co-authored by my co-author Wilfred Anim Odame, who is a consultant or principal of the National Development Planning Commission in Ghana. All right, so I'll go head straight to my research question. And what did we want to get out of this work? You know, obviously, most of us, when we start working on a research project, right? You know, sometimes it's sort of driven with the data. You know, when someone provides your data and you're thinking, what can you do with it? Or sometimes you have a question and then you go out looking for data. In my case, it was the other way around. I had data from my co-author, and I sort of just had to look through it and understand what was going on around it. And so what really stopped me was, okay, I had some mortgage data, which was provided by my co-author. And just, can I ask a simple question? The simple question is, you know, in terms of from the Ghana perspective, what determines mortgage loans from a Ghana perspective? And so that was the easy question that I thought that I could get out of it. But as we carried on and we started presenting it in conference, it seemed that the simple question wasn't good enough. And so I had to dig deeper to try to understand what sort of phenomenon could we introduce to this mortgage origination conundrum in Ghana. And what I thought about was how can we use the role of residential markets, because obviously we know that the property in itself is heterogeneous, right? So how can we then highlight how how residential market segmentations perhaps may have an impact on mortgage originations? And when we talk about mortgage originations, in this case, from the point of Ghana, we think about it from the loan values that have been originated, as well as the loan to value ratios that have also been originated from the bank's perspective. Okay, where is Ghana? I thought I would just, since you know, my audience is quite diverse, I didn't want to make an assumption that we all know where Ghana is. And so just to give an illustration of where Ghana is, so this is a big map of Africa. and I believe Africa, I stand to be corrected, might be perhaps the biggest continent in the world. And, it's quite a big, diverse continent. Like Prashant had said, I'm from Nigeria, but I live in South Africa. And today I'm speaking on Ghana. On the African continent, we have 54 countries, diverse languages, diverse culture, diverse real estate markets. So each country is quite different. And this is where Ghana is. Okay, so Ghana is on the western part of Africa. And just zooming down on Ghana, like I said, I shouldn't make the assumption that everyone knows about Ghana. Just basic stats, right, of Ghana. Total population of Ghana is 31.1 million people as at 2020. In terms of the gross domestic product, it's about $68.5 billion. GDP per capita is about $2,020 in Ghana. And in terms of the percentage of population below poverty line, it's about 48.4%. Inflation stands at 7%. So this is just some basic social economic indicators that, it just gives us an idea of the country Ghana. Okay, in terms of the motivation of our work and trying to understand outstanding residential mortgages within the African continent, it gives us an idea of where does Ghana stand, when we look at other African countries in terms of outstanding residential mortgages. If we look at the top 10 countries, we'd realize that Ghana is not present in top 10 countries of outstanding residential mortgages. And so what it says to us is that it really is a nascent or really emerging, as it says in the title of our work. Ghana is an emerging market in terms of origination of residential mortgages. And on the top there, we have South Africa, 1.7 million residential mortgages originated, and we have Nigeria, and working our way down to about Senegal with about 25,000. Again, what it shows us is that Africa still has there's a lot of opportunity, right, around the mortgage, the advancement of the mortgage markets within Africa. In terms of just giving us an idea of perhaps why is it that maybe the mortgage markets may not be as developed. There's been quite a number of work that has looked in that aspect, but something that I should just give you an understanding that maybe what perhaps could be driving this, right, is that when we look at the mortgage interest rates within Ghana or within Africa as a whole, the bar charts, the blue bar charts represent the mortgage rates, right? Whilst I think I have a question here. Let me just see what's. Okay, I think we'll just I'll go to the questions afterwards so I don't impact them. Yeah. So in terms of Ghana or in Africa in total, what we realize is that when we look at the typical mortgage rates, we realize that for most countries, you're looking at double digits mortgage rates. For most countries in Africa, you're looking at double digits mortgage rates, so 10% and above. Obviously, you're looking at high costs of mortgage finance, right? This obviously has quite a number of impact on take-up. And then when you look at the number of years as well, there's like quite a number of variation around the term of years. So we're looking at mostly between over 20 years. Most countries tend to be the terms over 20 years. If we look at the right-hand side, and obviously the left-hand side is the mortgage interest rates. Okay, all right. So when we look at it in terms of the motivation of our work and just trying to introduce in terms of where is South Africa? Sorry, Prashant. Yes.
The previous graph, that was pretty interesting. So the range of interest rates is as wide as between 3%, like US, all the way to 35% in Zambia.
Sorry, which country did you say, Prashant?
So 3% right after Ethiopia, is Gabon, right?
Gabon, yes, Gabon, yes, Gabon.
It's
Yes.
around 3%. And
Right.
then we have around 32% in Zambia.
Yeah, Mauritius. Oh, sorry. Yes, yes, just here. Zambia, yes, you're right. Zambia is 33%. Yeah, that's correct.
It's such a wide range of interest rates. And if we want to look at a pattern here, perhaps nations with more international relations seem to have lower interest rate. Please keep me honest on this. And where does South Africa stand here?
Yeah, I think that's
South Africa is around,
here.
excuse me, 12%. This is pretty much like India, more or less, like the BRICS economies.
To be honest, currently this work is 2020. As at 2021, the interest rates in South Africa dropped to about, because of COVID and stuff, they dropped to about 9.5%. Like it's gone single digits. So currently the mortgage rates are single digits.
Because of the monetary policy interventions, like happened in India as well. Okay. So that means that as the president of African Real Estate Society, you are dealing with a very heterogeneous set of countries. It's extremely heterogeneous, if we look at it that way, right? There are some countries where interest rates are as good as developed countries. In some other countries, interest rates are quite high. Comparative.
Yeah, I mean, what I said in the beginning, right, of the presentation, is that Africa sits on 54 countries, and it's totally independent. They're all independent countries. They all have their own independent central banks. They all have independent economies. Each economy is, I would say, the GDP of each economy is, very, very varied. And so that's what we're saying. It's a very, like I even mentioned, that even apart from mortgages and stuff, the culture is different around the continent. The population is different. Yeah. So it's quite very. The languages are different. Some places speak Portuguese, French, English. Yeah, and their trading partners are also different. Yeah. So it's particularly diverse. Yeah.
Thank you.
All right. All right, so when we look at South Africa and then we look at Ghana, I think the reason why I put South Africa there is just to look at, Ghana in comparison to South Africa. South Africa is sort of the leader in mortgage markets within Africa. And now we're trying to look at Ghana compared to South Africa. So in terms of outstanding transactions, in Ghana, just sitting at $747 million of outstanding mortgages. We compare that to South Africa of $67 billion. Yes, I understand that the population is quite different, but when we now look at a GDP ratio, what is the mortgage to GDP ratio? In Ghana, you're sitting at 0.14%. South Africa is sitting at 19.56%. So again, I think what it just shows is just that distinctive significance between understanding how small the Ghanaian mortgage market is. And, again, this research wants to sort of understand or sort of uncover, why, how the mortgage providers actually make those sort of decisions, and how can, policies around it actually improve that sort of uptake in the mortgage markets. Okay, so in the past as well, there's been quite a number of interventions by the Ghanaian government to stimulate the mortgage market. So in 2018, there was an input of $7.2 million from various sources, including pension funds, insurance funds. And then in 2019, there was about $240 million, which was pumped into housing and developing the mortgage market. And so what we see is that there's quite a number of interventions to sort of accelerate the mortgage market development within Ghana. Okay, so based on this understanding with the low mortgage penetration, and saying that the Ghanaian market is, it's highly constrained in terms of the illiquidity of the mortgage market. What this paper wanted to do was particularly to understand how mortgage originators make decisions for financial institutions as well as non-governmental organizations, and how that perhaps could be used in terms of policy formulation, to sort of stimulate the mortgage market in Ghana. And contributing to literature as well, we're trying to show evidence, evidence on the determinants of mortgages within Ghana that also can inform programs, can inform policies, and can also promote access to mortgage loans in Ghana. Okay, so I'll move on to the literature review. And so for us to carry on with our work, we had to sort of review past literature to understand what has currently been done in the areas of mortgages within Ghana or within Africa. And what we realize is that not much work has actually been done in this. And the number of work that we found that had been done was trying to understand why there isn't a mortgage uptake within Ghana, or what are the sort of limiting factors that can have has an impact on uptakes and stuff like that. We haven't really seen any paper on determinants of mortgage origination. Actually, there's no paper on determinants of mortgage origination. A paper by Asaberry in 2016 actually looked at mortgage financing and the gross net income per capita for African countries. That was perhaps one of the most similar to this current work. But as I mentioned, there's currently no work on mortgage originations and the determinants within Ghana. And so what we had to do then was to look outside of Ghana to see, what has been done in terms of the mortgage markets, and also sort of understanding segmentation, maybe residential segmentations. And when we looking in the US, there's been quite a number of work that has been done on mortgage originations and perhaps discrimination, which is the work by Faber as well. They highlight minority borrowers in the US are disadvantaged in terms of the mortgage approval process. So look at the impact of race and ethnic neighborhoods on mortgage originations. And also Ribal 2000 as well also did some work on that as well. They showed racial discrimination in Black and Hispanic applicants when it comes to mortgage originations. And so other work as well has actually looked at geographic market segmentation. So they're particularly looking at the subprime lending perspective and how that has impacted foreclosures of particular communities. Again, they found that there was more foreclosures in African American households in comparison to other households. And then the Wiley paper 28, they looked at the US urban system. Again, they found that the subprime mortgage segmentation has actually excavated and also reduced inequalities in denial-based exclusions. So there's quite a number of work on how the market segmentation from a racial perspective has had an impact on mortgage origination. Okay, but particularly there's been some work like Segal 2002. They tried to look at the multi-family mortgage market. And what they were saying distinctively in their work is that we need to recognize that properties are heterogeneous, even when they looked at it from a multi-family property perspective. So what they're saying is that these multi-family properties can be segmented, right? And they can be segmented, their characteristics, they even for multi-family, you even have larger properties and smaller properties that can obviously have an impact in mortgage origination. And a paper by Francois and Marius, they look at 5 rental submarkets in Canada and Quebec. And they also argued that their results showed significant difference in pricing from different markets investigated. And so what we're then seeing is that if we can see market segmentation or property segmentation from the ground level, and what we're trying to then understand is that from a mortgage origination level, do we see those sort of segmentations as well? So in terms of our literature gap, what are we trying to fill up in terms of literature? So as I said, existing literature, there's not much work on mortgage market developments in Africa. So in terms of the gap that we try to fill the mortgage originations within Ghana. Then also, for the first time, we try to look at transaction-based mortgage data. And so this is data that, you know, it's like sort of real life data, right? It's transaction data. And then gives us an opportunity to sort of interact this data with property characteristics and residential market segmentation and try to contribute to knowledge from an African point of view. In terms of the literature gap as well, we are tending to understand how Ghana mortgage lenders, how do they originate loan, and how do they do that with perhaps employing residential submarkets and housing characteristics. And we also measure their lending decision using loan values as well as loan to value ratios. And our study extends this by investigating the role of residential submarkets in mortgage originations in Ghana. All right, Prashant, I think you have a question.
Minor suggestion from my side. So when we cite literature from multifamily, are we mixing commercial mortgages with residential mortgages there? I'm sure this is a work in progress, but I was wondering if you would also look at residential mortgage market segmentation. Because a lot of these multifamily mortgages would eventually be securitized by Fannie Mae, and but they will go more towards commercial mortgage rather than residential mortgage. Just a minor observation.
Yes, I see your point there. I see your point there, Prashant. But remember that this mortgages, I think what you're trying to say is that they backed by your Freddie Mae's and Fannie Mae's, right? So there's the possibility that it's quite different from mortgages that are not backed by Fannie Mae and Freddie Mac. Is that where you're coming from?
Yeah, but I'm also talking about the nomenclature issue. So in multifamily assets, there the mortgagor would be a landlord who is acquiring the asset with a view to rent it out to someone else. So the lender would treat it as a commercial asset rather than a residential asset.
Okay.
So the whole phenomenon of market segmentation would be different, and how lenders would look at the market segmentation could be different. Just thinking aloud.
Okay, thanks for that. So I think what I would have to dig deeper into that paper as well to see, are they looking at it from the institutional level, which is, you know, or are they looking at it from the ground level? Thanks for pointing that out. And also, Prashant, I don't know, how do we deal with the questions? Because I'm also
it's totally up to you. We have had two questions so far. My friend Ashish Gupta was curious about the heterogeneity in interest rates, and I guess you have already addressed that question. But if you would like to go ahead and answer Kofi's question, then please go ahead.
All right, excellent. So Kofi said that in terms of volume in Africa, can we say Ghana is doing well per capita? Okay, this terms of okay. Yes, okay. I think you've made a good point, Kofi, in terms of what I showed was an aggregate level rather than per capita. But obviously, just looking at it, we can see that I think I also illustrated using the GDP.
Exactly. It was a small ratio, 0.14%. Yeah.
Right. So sort of leveled it up, right? So South Africa is 20%. Ghana is still 0.14. Yeah. So we can say that, you know, we can say that the volumes are quite low in Ghana, to be honest. Yeah. All right. Let me just have a look at Ashish's chat again, just to make sure I didn't miss it. Okay. What, according to you, are the factors that impact such a diverse rate? I think I did mention, yeah, I'd already answered that initially as well. To say that, you know, you actually having countries that operate in parallel markets, right? So it's not like a central, sometimes, sometimes people think that Africa is a country, but it's different countries run by different central banks, different economic policies completely different and stuff like that. And then maybe we can look at it as well is it could be an issue of liquidity, right? So, you know, and also maybe we can also go back and say, what are the housing policies again within each country, right? So if there isn't strong housing policies or maybe contributions to housing in terms of, you know, how much of maybe the budget or whatever is, you know, set aside for housing, that those as well can also perhaps have an impact on sort of the variability that we're seeing across countries. All right. Okay, so let's move on to the empirical data. So the data source for our work was from the Ghana home loans within Ghana. The leading financial institution in residential mortgages in Ghana, and there's been some restructuring within the Ghana home loans, and I think recently they have been acquired by First National Bank. And according to the Center for Affordable Housing, Housing Finance in 2018, Ghana only had 6,000 mortgages, and that's 6,000 mortgages in a country of 6.6 million households and 30 million population, so 6,000 mortgages. And in our work, we examined 1,500 transactions, meaning that obviously when we compare it to other markets or we compare it to other research, and Prashant and Dr. Yebewa is here as well. They've worked on the American markets, and you see papers that are working with hundreds and thousands of data or millions of data. Unfortunately, we don't have that sort of opportunity from an African context. But what we can say is that at least within this paper, we're investigating 25% of the total mortgage within the country of Ghana. I think, right, that's fine. All right, so in terms of the residential mortgages in Ghana, our data that we had was from 2008 to 2016. Again, so this sort of data is literally extremely difficult to get hold of. And so, whatever data you have, you just need to be thankful for it. But obviously you would realize that it's 2016, which is about 6 years ago. But in terms of the average loan within that period, we're looking at average loans of about $68,000. The lowest was in 2018, about $50,000. Highest was 2011 of 74. In terms of purchase price as well, we have an average purchase price of properties of about $112,000 US dollars. So the lowest and highest as well. In terms of loan to value ratios as well, average loan to value ratios was 96%. The lowest was 70%, highest was about 120%. And for me as well, when you sort of get data like this as well, sometimes you ask yourself, why is it that the loan to value ratio is 120%, meaning that loan to value ratio is higher than the purchase price. So it's sort of something that as well that, you can't really explain why it is, but what we have done in when we've got into our data is to try to clean those out, because otherwise it's you can have some errors. But this is just trying to report the data that we had, right? Prashant.
Yeah, my friend Divesh is here, and we are working on a similar project on Indian data, and we have hit a similar problem where the loan to value ratio is higher than 100%. So for our audience, loan to value ratio is what percent of your home value will be financed as loan by your bank. And you shouldn't expect it to be more than 100%. If you buy a property for $100,000, why should a bank give you $120,000 in loan? And we had the luxury of excluding such observations. And Professor Yaboa may be better positioned to kind of guess on what's going on. But one of our guesses was that sometimes the asset prices reporting on paper are lower by potential borrowers for various reasons. And the local banker may still have a better idea about the actual market price, which may differ from what you see on paper. So if the banking relationship is good, the lender may be able to give you more loan, but it is at the banker's own risk, at the lending institutions, that particular branch's own risk. Or this could simply be data entry error. You don't know.
Exactly. It's something that, as a researcher as well, you sort of scratch your head to understand what's going on. From a South African point of view, I do know that sometimes the bank gives higher than your mortgage. So for example, if your credit rating is so good and you have some expenses, right? So you have lawyer fees, you have what they call it, conveyancing fees, and whatever the case may be, the bank is happy to pay for all of that. And so what will happen is you'd have a higher loan to value ratio than, you have a higher loan to your purchase. And yes, I mean, I've been privileged to also get a mortgage in South Africa. So, it's, in my case as well, that was something that was quite similar as well. And so I think that's what I'm picking up from. The problem though is that now that we've gotten this data, we're not able to speak to the officer, right? To say, oh, why is, you can't really know what's going on, right? But from
one of the attendees here, Kula, Mr. Srinivas Reddy, is suggesting that the banks may also be paying for the taxes. So perhaps he's talking about title transfer tax or something like what we call as stamp duty, etc. In my opinion, it's very unlikely that a bank would be willing to pay for that. But if they do, they would be more like the subprime crisis time loans in the US, when they were not only making you 100% payment against the asset value, but on the top of that, the banks were also giving you financing your documentation fee and other loan fees, etc. Mr. Reddy, do you have something to add to this? Shruti is saying that for India, could it be including top-up loans for home improvements? That's a possibility as well, but my hunch is that these two loans would not be clubbed in the same contract. Mr. Kofi Gavu is saying, can we then assume that LTV ratios are wrongly computed by some countries, since all those incidental costs are incidental to the purchase of the property? Should there be a relook at this ratio? And I would let you reply to this as well, Kola. But yes, in our case, we have found some irregularities when it comes to calculating loan to value ratio. So sometimes it's a matter of taxonomy, sometimes it's a matter of slightly inconsistent method, especially with very large lenders.
Yeah, to be honest, I think obviously when you're looking at data as well, you also need to be very careful how you are treating the data, right? Obviously, your assumptions are important. So if you then make an assumption, now you're making an assumption that you're not sure of by saying that the bank cannot give up more than 100%. Obviously, that's going to have an impact. So you create a bias in your results, right? Because, or only if you say it upfront, to say, look, in our work, our assumption is that the banks would not give 100%. And so the results, whoever is reading your report would just make that assumption that, look, we're not dealing with loan values that are above purchase price, and we just have to leave it at that. Because we're on the blind side, as researchers, we're sort of a blind side, right? So another one I wanted to draw upon was Jonathan said that the JHL, the current bank that we had that provided us data of 25% of mortgages, and we should look at Republic Bank Stanbic. I think that that would be great. That would be great. If you have anybody from these banks that are willing to give data, please contact me. Like I already said, it's already getting this data is like a gold, right? It's you can't get it. I mean, you can't. It's very difficult to get it. I mean, even there's some people on the Ghanaian on the who are currently like people like Kofi Gavu and Yeboah. They know as well that getting data is just almost impossible, right? So yeah, so we're actually very privileged to have this data. I think it's a starting point, and I do agree with you that if we can get more data, that would be great. But I think we cannot just wait to say, just keep on waiting, right? We need to start understanding these markets.
Well, Professor Matarucci from Italy has asked a question, if you would like to answer that. Which type of data you have for each loan? Sometimes banks will not disclose all the information about the borrower and loans due to privacy rules. Could you provide us an idea of the type of data you have access?
All right, so the type of data that we had access to, right, is, yeah, it's just residential mortgage, right? It provided us with the value of the house. It provided us with the loan that was given by the bank. It provided us with certain variables that I would show afterwards, meaning the characteristics, the property characteristics, and that's where it stopped. Unfortunately, they were not willing to provide borrower characteristics. I don't know if that had to do with policies, not to share private information. I'm guessing that is the reason why. Otherwise, I can't really explain why they wouldn't give us the borrower characteristics. I think that may be some privacy rules or privacy laws within that. All right. So Prashant, can I just please ask that? Let me carry on.
Please,
so
sure.
I don't want to take. I know this is quite exciting, and there's so many questions, and it's it's a lot of excitement. Can I please finish the presentation?
Yes, please do. Okay. Then we'll take all the questions in the end.
Otherwise, sure. I think we're not going to be done until like 5:30. I don't want it to drag that long. All right. Okay, cool. Again, so what is happening is, what we then try to do is we try to look at our loan values that we had, and then we try to match it across residential submarkets. And so I'll explain later on what is going on with the zonings. And so I believe in Ghana or in Accra, they have, or Accra and Greater Accra, they have 4 zones. So they categorize it into upmarket areas, gated communities, zone 3 and zone 4, emerging markets and middle income. And what we are saying is that when the bank provides loans, they tend to give more loans out to the gated communities, which is zone 2, as well as zone 1, which is the upmarket. And they give less loans to emerging markets, zone 3, and middle income, zone 4. All right. Obviously, this could be dependent on the property values of those areas, meaning that you have more expensive properties within upmarket and gated communities. And then when we look at, okay, so I think that explains that. And then we then look at also loan to value ratios. Does it mean that because the upmarket and the gated communities have higher loan values, does it mean that they have higher loan value ratios? Actually, the reverse was the case. So what we are finding was that the Ghana home loans were actually giving a higher loan to value ratios to the emerging and middle income in comparisons to the gated and up markets. And so in our methodology, what we try to understand is, what are the determinants of mortgage loans within Ghana, and what are the determinants of loan to value ratios within Ghana? And we're going to try to understand that using the property characteristics and segmentation, residential market segmentations. And so with a dependent variable, we use the log of the loan, we use the loan to value ratio, and on the independent variables, we use a vector of variables that explain mortgage underwriting guidelines. Like I said, the property characteristics, as well as the residential market segmentation. And so what we've done in our methodology for variables and specifications, we looked at, as I mentioned, two dependent variables, meaning the loan amount as well as the loan to value ratio. And then we introduced, again, it's quite, what we had is quite limited, right? The data we had was quite limited. And so we just had to work with what we had. And so we have provided property characteristics such as number of bedrooms, the plot size, the log floor area, if the property was within Accra or outside of Accra, if it was, so Accra is the major city within Ghana. And then if it was a detached dummy or not detached, meaning that is it a standalone sort of property? And past literature have examined this and they've shown that it can have an impact on loan values or high or loan to value ratios. And then what we did as a contribution to our work is to introduce these zones within our within our transacted data. We introduce these zones to be able to understand how it impacts loan values and how it impacts loan to value ratios. Okay, so just to give an understanding of the neighborhood characteristics. So these are the definitions of what is a zone 1, what is a zone 2, what is a zone 3, what is a zone 4. And then it also gives us the locations of each zones. And so it was then easier for us to match that with our current data. And so we just have to, we look through our data because the bank actually provided us with the exact location of the property in terms of the address, so we can then match it to the zones to sort of segment it using this residential segmentation. Okay, I won't go too much into it because I'm sort of running out of time. And so the comparison across residential submarkets, what we're looking at is, we found that within the zone 2, right, the gated communities tend to have the highest loan values. So we're looking at an average of $160,000 US in terms of the loan given for gated markets. And the lowest was middle income markets, $48,000 US. But the loan to value ratio is telling a different story. So although the up markets have been given higher loan to value ratios, it meant that they're actually providing more down payment in comparison to other markets like the emerging middle and middle income, right? So we're seeing that the emerging and middle income have a higher average loan to value ratio in our data. And so we have other variables as the bedrooms, plot size, and floor area, which I wouldn't really go into. So what we try to do as well was, with the data we had, we try to run a sort of a simple correlation just to see if you know, those variables sort of perfectly correlated, and then we had to remove some and so forth. So we don't pick sort of any perfect correlation or sort of high correlation within our variables, and so we then decided to make use of it in the following model. Okay, so with the first results, right, what we try to understand from our question, like I said at the beginning, was what are the determinants of mortgage origination within Ghana and then loan to value ratios. So this particular slide was looking at the variables that impact origination of loans. And so, because what was important to us is that we wanted to understand the property market segmentation aspect. So when in the first model, what we then run is we just run it's a dummy variable. So if it's a zone 1, we put it as 1. If it's not, we put it as 0. We want to understand, if you were in an upmarket area, how would the bank react to providing you with loan values? If you were in an emerging zone, how would the bank respond? If you're in a mid-income, how would the bank respond? And so when we look at it from a loan to value, from a loan value perspective, what we're seeing is that in these three zones, there's a possibility that if you're within these three zones, there's a possibility that your loan to value would tend to be, or your loan values in terms of dollar amount would tend to be lower. And then lower in comparison to what? Lower in comparison to the gated communities. And then when we introduce other variables the past literature have said have an impact on loan values, we introduce the bedrooms, the plot size, floor area, and then again, what we find is that the result still holds, meaning that when we compare zone 1, 3, and 4 to zone 2, which is the gated, the bank tends to give lower loan to value or lower loan values to these zones in comparison to gated communities. And then we also introduce the dummy variables that talks about if the property is a detached property, if it has an outhouse would mean like some properties would have a quarters, like the, sort of the maid quarters and stuff like that. That can also impact the sort of, the loan values. And what we picked up is that, I'll go on to the results. What we picked up when we looked at it from property characteristics perspective, we found out that the number of bedrooms has an impact on the loan values. And the findings is also expected, is in line with the Schilling paper of 1990. When we look at it from the detached property perspective, meaning that if my property was meant to be a detached property, there's a possibility that I will get a higher loan value from the bank. Again, it's in line with past literature like Leo and Muse 2012. And then when we looked at what we were trying to differentiate our paper from other papers, looking at property market segmentations within the zones within Ghana, what we found is that if you had a property within a gated community in Ghana, there's a likelihood that you would get a higher loan value. And so the next question that we then sought to look at is, how does a higher loan to value ratio, or what impacts loan to value ratios? And so if I had a higher loan to value ratio, or if I had a lower loan to value ratio, what is driving this? And does my property being in a specific zone actually have an impact in that sort of decision making? And so when we looked at our first model, what we realized is that if my property were in an emerging zone or in a mid-income zone, there is a higher likelihood that the bank will be willing to give me a higher loan to value ratio. And then when we control it with property characteristics, we're picking up the same results as well. And so what is the impact of market segmentations on loan to value ratios? What we find out is that properties within the emerging upmarket as well as the middle income market are more likely to attract a higher loan to value ratios. Okay, so in terms of conclusions, when we look at prior literature on the dynamics of mortgages, a lot of papers that I've shown earlier in the literature review, they tend to focus on developed markets, and there's a lack of understanding in emerging markets. And I think the reason why is, like I said, is the data is limited, very, very limited data. And this paper focuses on what determines mortgage origination, what determines high loan to value ratio from a Ghanaian point of view, using a single mortgage bank. And what we do is that we show the determinants of loan decisions, loan to value ratios, which is something that's a novelty within the Ghanaian market. In terms of our conclusion, our study finds evidence of neighborhood characteristics and that they determine how mortgage originates. So precisely from a Ghana point of view, we see that if the property were within an emerging upmarket and a middle income, they tend to attract lower loan values in comparison to properties within a gated community. In terms of housing characteristics, what past literature has said, we're sort of seeing that within the Ghanaian market in terms of the higher the number of bedrooms, the higher the loan value, the loan value that will be given by the bank. The higher the plot size, the higher the loan value. If the property was a detached property, there's a higher chance of getting a higher loan value. If they had an outhouse, meaning that if it had like a maid quarters or whatever, there's a likely chance that you get a higher loan value. So we're picking this up as variables that perhaps the banks consider. So again, furthermore, the results of our study also highlights, in terms of higher loan to value ratios, that the specific zones tend to attract higher loan to value ratios. So if the property were within an emerging zone or a middle income zone, there's a possibility that you tend to attract a higher loan to value ratio. Again, looking at it as well, I obviously I'm not from Ghana, or I don't work in the mortgage market. So I'm sort of scratching my head to say, why would the bank be giving a higher loan to value ratio to the emerging and middle income? I would have thought that it would be the reverse. So those are some of the things that obviously we need to pick our brain, further to sort of, understand why this is the case. And in terms of implications, we do know from this work that the quality of the neighborhood can tend to influence your loan values, can also tend to influence your loan to value ratios. In terms of policy formulation, what we're looking at is perhaps, when we look at these zones, it seems that some zones have better infrastructure. And is that what is driving that sort of decision for the bank to give higher loan to values? Maybe they're saying that, oh, perhaps if this zone has better infrastructure, there's a possibility that it can have higher valuations in the future, so that perhaps even if the borrower defaults, there's a possibility that they can get their money back. So those are the kind of things that perhaps maybe in terms of a policy point of view, infrastructure financing of the quality of neighborhoods is quite important. And the sort of limitation of our work, which we do agree as a limitation, is that, first of all, our work comes from a single a mortgage provider. So obviously, there could be some elements of bias there, right? Because, we could just be tracking that idiosyncrasy of that particular mortgage, right? And if we had 4 or 5 mortgage providers, it again gives us a better, a better understanding of how the mortgage markets actually work. Then finally, it would have been great for us if we had borrower characteristics. I mean, we do know that from an underwriting point of view, the borrower characteristics is very, very important when banks actually, originate loans, or they give a higher loan to value ratios. And so, unfortunately, it wasn't the data that we could get hold of. And the census data, I think the last census was, the Ghanaians are in the house, so let me not say something wrong, but the last census was quite a while ago, and we don't have the census data. Maybe perhaps what we can do is think about matching it, since we have the particular addresses of the homes, but unfortunately it's something that we couldn't have done, with the limited data that we had. And so, thank you. The comments are very welcome. As I said, this is a working paper. As I said, it's now under the second review of the Housing Journal, and we sort of fixing. But yeah, so I mean, like, we're looking forward to comments around this, and thanks, Prashant.
Thanks, Kola. We do have a bunch of suggestions. And in the interest of time, we just have 10 minutes left. We have a question on LTV ratio from Mr. Ernest Adu. So for the time being, I'm taking the liberty to move on to the question by Professor Gianluca Materocci. He has a suggestion. He says that I do understand that you do not have data about the borrowers, as normally happens with data from banks. But you can add probably some data about the average income by area or other data collected from the Central Institute of Statistics. But as you said that Ghana hasn't done a census for a while, so this data may perhaps be slightly outdated. And then we have a comment from Srinivas Reddy is saying that a prudent bank would fund the lower of the two, professional estimation versus actual price paid to the developer. Okay. We have a comment from Mr. Kenneth Donkor Yemen. He says he likes this study. His concern is with the gated community nomenclature, which is presented as a unique group from the upmarket, middle income market, and the emerging market. He says that this classification is from Dr. Animodame's previous works, and he's not too sure about the uniqueness of the gated community group from the other markets, because the upmarket, emerging market, so maybe he has a suggestion about having a relook at the nomenclature. Then we have, okay, Mr. Kofi is saying that Ghana did have a census recently, so maybe you may want to have a look at it.
Sorry, Prashant, did you want me to respond? Hello, is Prashant frozen? Can anyone hear me? Or is it... Can anyone hear me? Okay, all right. Okay, so let me just go on to the comments. Let me go on to the comments. Okay, Prashant is back. Sorry, Prashant, we can't hear you. We can't hear you, Prashant.
Can you hear me now?
Yeah.
Okay, I'm sorry, I had problems with my internet connection. My computer also just crashed, as happens. If you would like to go ahead and answer a question from the Q&A panel, I think there is one question there that is left unanswered.
Okay, sorry, Prashant, can you guide me, please? Because
on Zoom, there is an icon called Q&A.
Yes.
Just click on that.
Okay.
You have already answered the first one. If you could scroll down to the second question.
Is it the one? I think I did answer it. Is it the one that with Jonathan, right? He talked about you know, the Ghana home loans which I use is just a single mortgage provider, and that it's better that I look at other banks.
Right. So you're suggesting that
yeah, I think, to be honest, I think this is, you know, I think a lot of things is all about data, right? You know, I think if we had it, definitely we'll do it. But it's just, yeah, you know, these are the things. And I think Prashant as well, you also moving to India as well. I think this is what you have to deal with, right?
Right. Yeah, data is always a challenge. But on that note, Kola, before we part, I do have some suggestions from my side. Ladies and gentlemen, I'm unable to see your comments because right now I'm attending from my mobile phone. So excuse me for that. But I have three suggestions for you, Kola. One, and one of the audience also hinted at this, that the fact that the middle segments get higher loan to value ratio should not be surprising, and there may be multiple reasons for it. One, if there is an active secondary market, then the middle segments create a product that is more liquid. You know, there are more takers for that product rather than takers of the extreme ends of the spectrum. Secondly, it may also have something to do with the variation in interest rate and the term of the loan. So a lot of these lenders are chasing a certain target, and they have to sell so much of dollars in loans. So long as they are able to meet their target, playing with the loan to value ratio across different segments should still be fine. The next is the relationship between interest rate and loan term. So if there is an expensive loan, they would be okay either to reduce the loan term or reduce the loan amount. Either way, they will be able to meet their annual profit, and then they can recycle their cash throughout. Another idea here to look at, perhaps additional variables that you could potentially include, is simply a measure of atypicality. As one of the respondents has some concerns about the nomenclature, what you could do is just potentially develop a measure of, let's say, the size of the home, or the status of the location of the house, throw it on some kind of a scale, and identify assets which are on the extremes. So these are the assets where the loans would not adhere to your normal expectations. Similar to, shooting for the middle. So a lot of these lenders will be much more comfortable giving out loans to a typical borrower who is buying a typical asset, rather than a borrower who is ultra rich or relatively poor, or a borrower who is buying an ultra big house versus a borrower who is buying a very small house. So it's, they are of course more comfortable selling their loans to the middle segment. And lastly, as Professor Matarochi was asking, do you have data on the geographic coordinates of the assets that are being financed, like latitude, longitude, or addresses, or zip code, or?
No, we have addresses.
You do have addresses. So I think right now the explanatory powers are around 30 to 40%, which is not bad. But one possibility to improve that would be to simply include the spatial auto-regression. And my hunch is that in loan to value ratios in particular, if not in the loan amount, there will be a significant auto-regressive component, spatial auto-regressive component, which may improve the explanatory power of the model as well. So I'm done from my side. If you see any comments or chats, please go ahead and respond to them.
All right, excellent. Thanks, Prashant, for those suggestions. Yeah, I think that it is some of the suggestions. I think the final one with a special auto-regression, I think maybe there's a possibility there, like you mentioned, that maybe it could increase the R squared, right? I think it's something that we can definitely look at. I think, yes, with what Rama said, I think I'd also mentioned that it would be great if we had personal characteristics, income, education. We know that this is what banks do for underwriting, but unfortunately, we do not have it. I think I also want to sort of hear from the guys in Ghana. Kofi, I think, mentioned that the last census of Ghana was last year, but the results are yet to be out. So I think, again, that's sort of, yeah. Okay. With the Kenneth Donker's question around the zoning that we used, if I'm not mistaken, I think, yes, our name used it in one of his papers, but I thought that this zoning was actually something that was used widely within Accra. Please, you can let me know if I'm right. I'll be happy to sort of learn around that as well, because my understanding was that this sort of residential segmentation was widely used, or not widely used, but is being used. I'm not sure if Kenneth can assist me.
Okay, I guess I have posed these questions to you already, Kula. Yeah. And this is time that we wrap this session up. It's dinner time in India, and Mr. Ernest Adu has one last comment for you. We are very thankful to you for having accepted our invitation. Because as you rightly pointed out, for researchers in India, data is as much a problem as in many parts of Africa. And this exchange is a healthy exchange where we not only exchange ideas and research and findings, but also the limitations about conducting research. It also sends a message that we are not lonely in this fight for researching about countries beyond the developed countries, with which a lot of publications are quite saturated. So in a way, we are helping democratize the social sciences and economics of the world. Thank you very much, Dr. Akinsomi, for accepting our invitation. We hope to bring you back here physically or virtually whenever possible. And ladies and gentlemen, our next event from the Mishra Center would be a panel on REIT. We will have a CEO from one of the top REITs in India. He will be accompanied by the Vice President of Research of the National Association of REITs in the US, and with a leading professor on REITs in the United States. Stay tuned. We will announce the event very soon. Thank you very much for your patience with all the technological problems. Thank you, Professor Akinsomi. Thank you, Riddhi. Thank you, Nico. And thank you, everyone, for being here. Have a wonderful evening.
Thank you,
sir.
And thank you, Reddy, as well. Thank you so much for your help. I really appreciate your invitation.
Thank you. Thank you so much. Thank you. Have a nice day.
Yes, thank you.